Good day to all. This is our discussions involving using discounted cash flow analysis to make investment decisions. Actually, this topic is closely connected to capital budgeting that is fully discussed in any fundamentals of financial management course. So I'm pretty sure if you are done with that, well, you can very well connect to this one. So DCF model is using the time value of money concepts, especially for present value computations. Our tasks for today or for this particular session will be as follows. And these are our topics: identifying cash flows involving investments, calculating these or those cash flows, and we have an example at the end. So first step is to differentiate cash flow versus accounting income. Now, we all know that the two are different, hopefully, at this point in time, and that accounting income is based on financial accounting and reporting based on our accounting standards. Also, cash flows, however, in financial management, our focus is more on management of cash flows because these are the sources of financing of the business that will be used in any investment opportunities or those activities and endeavors about business that would earn more returns or profits for the business. And then what we do with those cash flows would be to discount them. Then using accounting income rather than cash flow could lead to erroneous decisions. And this is very important since if, again, we use our accounting income or profit, then that would affect our analysis. Since profit is based on history and not necessarily prospective or future-oriented in nature, as opposed to our cash flows, wherein we can make use of that to project or to forecast what can happen in the future. Now, next to that is an example. So I'll give you a minute in order for you to go over with this particular problem. So what you can do is to pause this video if you are watching this one. All right, so 1 minute has now passed. And let's go over to the example. A project costs $2,000 and then it is expected to last for 2 years. Then it would produce cash income of $1,500 and $500 respectively. Now we have to take note that the cash income here is basically produced, and this is cash basis. The cost of the project can be depreciated at $1,000 per year. This is depreciation expense. Given a 10% required return, which is the discount rate, we compare now the net present value using cash flow to the net present value using our accounting income. So we will see like which would be beneficial, which would be relevant to our analysis for making investments in financial management perspectives. Now, we have to take note also that the normal case or situation is that the operating profit or income is given than the cash flow or the cash flow from operating activities. So that's why what we have to do is we are going to get then our cash from operating activities. So is to work back. So from our net income from accrual basis of accounting, we work back to our cash flows, especially for our cash flow from operating activities. So what we can see there is that it's a movement from accrual basis to cash basis of accounting. But for this problem, we are given the cash basis income already. So please take note of that. Now we can see on the subsequent solutions for comparison purposes that this is our cash inflow. And then today at time 0, then years 1 and 2. Going back to the problem that this project will last or expected to last for 2 years. Then project cost is $2,000. So that's why the FCF or free cash flow for today is negative, and then years 1 and 2 would result to positive cash flows. And if we compute the net present value, in which in capital budgeting, this is just one section, and this is basically the difference, or we can say the sum, because Our present value of cash inflows would be the positive amounts, while our cash outflows would be the negative amounts, respectively. Since our investments are done at time zero, therefore no need to discount them unless it is stated in the problem that these cash flows are to be made in the future. So that's why we also have to compute the present value of those investments. However, if it is as simple as this one, so our cost of investment, which is negative 2,000, is as is, while the subsequent cash flows will have to be discounted. So that would be 1,500 over 1.10 to the power of 1. And any number with 1 as an exponent equals the number plus 500 divided by 1.10 to the power of 2. Of course, our formula also would be that is the cash flow multiplied by the quantity 1 plus the discount rate to the power of negative n. Especially if we are using our scientific calculators, then this would be easy to compute, or on our end, it would be easier to compute then. And thereby would be getting $223.14. So this is how we compute. If ever we are going to use accounting income, we can notice here the importance of what I said a while ago. We said that at the given of the problem, we are basically given the cash inflows. So we have $1,500 and $500 respectively. These are already the cash inflows. So again, the normal flow is from the accounting income, accrual basis of accounting, going back or squeezing our cash flows. But what we can see here is the opposite of that flow. So the cash inflow, instead of adding back depreciation, because we're going back and forth, so we have to deduct to get the accounting income. So we have positive 500 and negative 500 in dollars respectively, and we can compute our respective cash flows. So in this particular case, this would be our present value of our cash inflows, and then sad to say we have an outflow, and we can deduct this from our cost of investment so that we can get our difference of our net present value. So we can really see at this point in time that there would be difference. If we go back, the net present value is this one, while our net present value would be different for this case. It would be the sum or the result. Should we combine these two inflows in years 1 and 2, then plus negative 2,000 or minus 2,000, that will be the NPV, which is for sure a negative amount in accounting income. So had we used accounting income, then our decision would have been different, because remember, under NPV concept or net present value concept, if the NPV is at least greater than 0 or positive, any positive figure, then we are going to accept the proposal, unless if we have limited capital or budget, wherein we do budgeting, also known as capital rationing in capital budgeting concepts, wherein we only prioritize the ones that would result to the highest or higher net present value. In these analysis, we have to take note of the following. We only include the incremental, also known as marginal or differential cash flows. Again, in financial management, we only focus on the margin. We only focus on what can be added more. Next would be to include all indirect effects. Whether these are direct or indirect, for as long as they are applicable to the problem, they are closely related to the problem, then we have to include them. Next is to forget whatever has been sunk. Sunk costs have been incurred from the past. They are no longer connected. They are no longer related in the present. For the fourth one, we include the opportunity costs or the benefit foregone should we use this alternative or investment proposal or project over the other. Next is to recognize the investment in working capital. So the investments in working capital from our current assets down to current liabilities will have to be recognized. So in fact, any changes of them have to be incorporated to get our cash flows from operating activities. So we've known that from statement of cash flows. Also, we should know the terminal or the last part or the ending cash flows of the project, in which for some cases, if ever the projects would have like continuous or continuing cash flows at the end of a certain period of time or point in time, then we are going to also approximate the cash flows of that or the present value of cash flows. Then beware of allocated overhead costs, especially if these are non-differential and these are fixed. Otherwise, if they're avoidable, meaning if we do not enter again in this particular project, we would not incur, we would not be allocated these overhead costs, then we will not recognize such. So in that case, avoidable allocated overhead costs have to be included. But if simply allocated, no. Now, incremental cash flow is the cash flow with the project minus without the project. So again, it's the differential cash flow. Now, important questions would be as follows. Would the cash flow still exist if the project does not exist? So this is the point of now determining if whether a certain cash flow or the cash flows of a certain project actually are differential or not. Because if they exist, or if the answer is yes, they still exist even if we do not make the project, therefore they're not differential. They're like fixed. But if they would only exist if we enter this project, so meaning they are actually variable, they would change between alternatives, so include such in our analysis. Now, inflation also plays important role in our analysis. So in this case, because we all know that costs and expenses could change in the long run or even in the short term for inflation, also our income can change. So we have to incorporate this. And this is now a review of nominal rates, which are the inflation rates or interest rates that are the face amounts or values or the stated or the slated values. But our real rates or real inflation rates are the ones with the incorporation already of the inflation. So that's why we have to know the nominal versus the real interest rates. The real would now have the inflation rates being incorporated. So we may, for analysis purposes, show the nominal versus real interest rates used in discounting. However, at the end of this particular section, we would really know that real interest rates are favored. Anyway, so that's an important thing that we have to take note for this one. We would see here the last part that we will get the same results, whether we use nominal or real figures will be something of debate, because if we just follow our formulas, then such would result to different figures. But I guess if we are going to incorporate or go back by multiplying whatever values or present values of our inflows towards the nominal ones, then we would be getting the same answers. Anyway, allow me to show. So, example, you own a lease that will cost you $8,000 next year, increasing at 3% a year, which is our forecasted inflation rate for 3 additional years, 4 years total. If discount rates are 10%, what is the present value cost of the lease? Now, there are 4 years. However, if we make analysis at the end of a certain year, so that would equate to 3 more years. Since the $8,000 will be for the next year from our analysis of the end of a certain year. So I will give you a minute to analyze this one and make sure to pause this video. And now we're back. So for sure you're able to already read the problem. Now this is our formula to be able to compute our real interest rate. So the real interest rate would be actually squeezed. So whatever is our nominal rate or interest rate, we add 1 and we divide that by the sum of 1 plus the inflation rate. So we will get 1 plus the real interest rate. If we deduct 1 from the sum of that, then we will get our real interest rate. So example for this one, 1.10 divided by 1.03 that would be equivalent to 1.067961. So minus 1, we get 0.067961 or 6.7961%. And that's why we will see that in our table later. For the nominal figures, if we just follow the PV of one concept for an even cash flow, so we will be getting this particular present values of our cash inflows plus the total. Now, if we are going to use the real figures, we can notice that the values changed. It is because actually, if we go back, our denominator here for the cash flows are bigger. So the basic concept in capital budgeting as well as the computations of present values or simply the discounting concepts is that all other things being constant, the higher the interest rates, the lesser the present value factors, the lesser the present values. So that's why here with the higher 10%, which is nominal rate, with the incorporation of inflation, expect that the rate would be lower at 6.7961%. So that's the reason that we'll have higher cash inflows. But going back to our concept a while ago that it will result in the same, probably if you are going to, for example, multiply of each value with whatever is the amount a while ago or the multiplier from 8,000 to become 8 to 40, then that would result to the same. So example, if we multiply 7716 times the 1.03 and so on, 1.03 squared for the next and 1.03 cubed, then probably we will be getting the more or less similar answer. All right, so please take note of that. Now, allow me to go back to this particular part here or sentence here under inflation rule that you will get the same results whether we use or you use nominal or real figures. So by that, since that's the concept, so I really thought about it and I came up with the following. So a while ago, the illustration was quite different. In fact, this was not the version that I have shown. So I edited the table and the figure so that it would be consistent with whatever concept that we are trying to present. So we can now notice if we go back to nominal, it's a total of $21,073, while it's also true for the real figures. It's because the difference actually is the value, nominal value of the cash flow or cash flows. If we use the 8,000 for real figures, then that would result to that two being equal. Since for the nominal figures, we're actually using not the 8,000, but we are calculating the future value of such. So with that, because we do not incorporate the inflation rates to the 10%, therefore we have to forecast or project the value of the cash flows in the future by the 3% inflation rate. But if we use the real figures, then we have to use only the nominal value of the cash flows, not the values in the future. All right, so that's why the two would be equal. Hopefully that makes it clear. Now, for investment and financing decisions, we have to make sure that if they're separate, then we are not going to include such in our analysis for a particular investment. When valuing a project, ignore how the project is financed. So we just simply assume that whatever would be the sources of financing, then that's it, or those are for the particular project. So whether that's going to be by, for example, whatever means, what is clear is that we have the respective outflows for the meantime. Following the logic from incremental analysis, ask yourself the following question. Is the project existence dependent on the financing? If it is a yes, then we are not going to separate from financing because it is dependent. So in other words, it exists because of the financing. But if no, it is really separate or it's not dependent from our financing sources or activities or means, then we are going to separate such. So that's why, again, we ignore. In fact, there's a concept that we are going to act as if the sources of our financing would be equity. Because for equity, it's a simple discounting of our cash flows. Now think of cash flows as coming from three elements. Total cash flow is from the capital investments, from changes in working capital and operating cash flows. However, we would like also to argue, especially for other sources, that for the changes in working capital, basically these are already part of our changes in working capital incorporated from working back net income or operating profit to our cash flows provided by operating activities, if positive, or used in if negative. But we just have to respect the presentation here. So cash flow from capital investments would, of course, our initial or our first ever investments that will be placed in the company's coffers for the particular investment activities. This is often capitalized from an accounting perspective. So that's how we use the term. So capitalized meaning you're going to add. In finance, the investment represents a negative cash flow. That's true. If we think of financial accounting, any investment is an addition to a particular asset, for example, because that is basically an additional value that would provide future economic benefits. But for cash flow analysis, then we are going to present that as an outflow. So initial negative outflow. If we are going to think also and extend our analysis, actually it's not far if we think of our accounting and also finance. In accounting, we capitalize, really add, because we're talking about the value of the investment. But if we think of the outflows now, if we carry that concept to finance, then we are going to put that as a minus again, because we're talking about the cash flows in relation to investment. So that's the point of it, meaning they are not actually arguing with each other. So operating cash flow is this formula, revenue minus costs minus taxes. But then again, the presentation here is that the working capital is separate, but in reality, especially for our discussions in cash flows, we all know that we will have to include as well our changes in working capital to be able to incorporate again that to derive our cash flows from operating activities. So simply, or normally the concept, right, is to just simply add back whatever non-cash expenses, we deduct any non-cash income, and then we are going to include the changes in working capital. So anything that would increase our assets would be deducted because the movement is from our equity to cash flow. So normally anything that would increase assets, basically there's a corresponding increase in equity. So to go back to cash flows, we deduct, and anything that would increase liabilities would be added back because basically that would present that there is an outflow. So if, let's say, assets would increase, meaning we invested in assets, right? So that's why we are going to deduct such. So that's an outflow for the assets. But then for liabilities, if they increased, so for the latter, it will be the minus now. Since if liabilities would increase, remember there's an inverse relationship between liabilities and our equity. So if liabilities would increase, then our equity would also do or move in opposite direction, and that is to decrease. So it would decrease, meaning to say we are going to add back. So it would decrease in that impact. And then, but really, if you think about it, increase in assets would be more investments in assets, so more outflows. But if liabilities would increase, meaning to say we're not paying our liabilities or we are having more liabilities. All right, so meaning that's an inflow. That's the point of that or sense. I'm just trying to review you guys about the cash flows. For the methods of handling depreciation, we have method one, dollars in minus dollars out, for adjusted accounting profits and add back depreciation tax shield. So let's check what has been shown here. Actually, it's basically our dollars in minus dollars out. Anyhow, so this is our presentation for year zero again for any capital investments, initial and the outflow. So that would be at year zero, our initial year or the very first time that we are putting our money. So that's why this would be negative later on. And we have 6 years for our tracking of the cash inflows as well as the outflows if ever possible. So for working capital, this is the gross amount, or these are the gross amounts from years 1 to 6. And the changes in working capital will be this year minus previous year. In year zero, because there's no comparison, there's no comparability achieved from this point in time and the previous one, that's why it will be equivalent to itself. While year one would be 4075 minus the previous year 15. So that's why we get 2,575. Okay, so for year two, that's 4,279 minus 4,075 equals 204. 4493 minus 4279 equals 214, so and so on. While from revenues down to profit is basically, we all know that to get pre-tax profit, which is clearly before tax, pre means before, so revenues minus expenses minus depreciation. That would be the pre-tax profit. And then if we are going to deduct the tax, which is the percentage, 35% in this problem, multiplied by pre-tax profit. So 3,000, for example, times 0.35 is 1,050, and 3,000 minus 1,050 is 1,950, and so on and so forth. So these are our respective gathering and computations for the values. So in other words, these are how we obtain our respective answers. All values, by the way, in thousands of dollars. Now, for the cash flow from operations in thousands, I repeat, this is somehow lacking, but we just have to respect this particular presentation. We are now able to get our net profit. So what we do to get that initial cash flow from operations is to add back depreciation. And yes, it's true because this is in thousands, so 3,950 is really $3,950,000. Now, next would be for working capital. This is just an assumption that for receivables, that is 2 months of our total revenues. So that's why we divide it by 12 and then 2 months times 2. So the fraction is 2 over 12. It would result to the same. Inventories would be 0.15 of the years following or the following year's expenses. So we base that on our going back expenses here, and that's for the year zero because our expenses is 15,000. So times, is it 15,000? That's the revenue rather. Expenses would be 10,000. So 10,000 times 0.15. While for year two, 10,500 times 0.15. So that is equivalent to 1,575 or 1,575, which should be our inventory levels for year one. So I repeat, inventories would be 0.15 of the following year's expenses. So how we get that? 0.15 times the following year's expenses. And the working capital is just the sum of numbers 1 and 2. Now, for the net cash flow for the entire project in thousands, well, we simply have to incorporate our initial capital investment of negative 10,000 and the changes in working capital here. We also have a salvage value inflow at year 6. For cash flow from operations, we have to add them. We can notice that from year 0 to year 4, we actually have negative change in working capital because if we go back to this table, take note that from profit down to the computation of our working capital, we can see that we have here our positive working capital. And if we are going to get the net from year 1 and 0, year 2 and 1, so we basically get our change in working capital at positive amounts, except in years 5 and 6. So as what we said a while ago, if positive, this means that our current assets are greater than current liabilities, but we're just shown here our receivables and inventories. So with that, any increase in asset would basically result to more investment, therefore an outflow. So that's why it is, or they are negative here, since we're talking about plenty of years. And our respective total cash flows now, or we can revise the profit here as the net cash flows actually as follows: negative from year 0 and positive from years 1 to 6 respectively. At year 0, it is expected to be negative because, of course, this is the year that we are making huge amount of cash outflows or investments. And if we are going to compute the net present value, then we are going to simply multiply each with our discount rate, for example, at 12%, by the factor 1 plus the rate to the power of negative n, wherein n is the number of the years, or the nth number of years. So for year 0, that's as is, because that is our initial investment or outflow. For year 1, that would be 1,375 multiplied by the quantity 1.12 to the power of 1. For year 2, that's actually our 3,909 net cash flow multiplied by the quantity 1.12 to the power of 2, and so on and so forth. And if we get the sum, that would be the net present value. All right? So just a little patience for the movement, or a necessary movement of the slides. Anyway, thank you very much for listening, guys. And God bless to everybody. See you in the next series of our videos.